Welcome back to Lesson 2 of Store University, how to calculate returns on equity and get really, really rich. I'm Chris Volk, CEO of Store Capital. In the first two parts of this lesson, we learned the components that contribute to equity rates of return. Now, what we're going to do is put these components to some use. Let's take a hypothetical business. It has $1 million in assets at cost. Remember, the assets are not just real estate or furniture, fixtures, and equipment. We're talking about anything that has to be paid for with other people's money or your own money, which is to say shareholder equity. So that will include inventory, accounts receivable, prepaid costs, minimum cash balances to the extent that such cash outlays cannot be carried by your vendors. In business parlance, that is often referred to as working capital. Now let's turn to sales. We're going to assume $1.5 million annually. And operating profit, or earnings before interest, taxes, depreciation, and amortization as a percentage of revenues, and we're assuming a profit margin here of 20% of sales on line 2, which pencils out to $300,000 a year. Then there's the amount of the enterprise that's funded with OPM, or other people's money. Given the total assets shown on line 1, how much can be financed with other people's money? Here we're assuming 75%. This is actually quite a lot, but it's doable, especially if a piece of total assets includes real estate, and especially if you can execute real estate leases with somebody like Store Capital. Interest and rent expense. We're assuming an interest and rent cost, to the extent that you use leases to finance your real estate, equal to 9% of the OPM used on line 4. Then there's the average annual capital expenditures. We're assuming regular maintenance capital expenditures equal to 2% of the total investment of assets at cost, which is line 1. This means that your pre-tax cash flow is just line 3, less lines 5 and line 6. And if your corporate tax rate is 25%, then after-tax cash flow would be 75% of line 7. Now, if the amount of OPM is 75% and the cost of the assets on line 1 is $1 million, then the proportion of equity must be 25%, and the amount of that equity is $250,000. That makes computing the return on equity simple. Just divide line 7 into line 9, you get the pre-tax rate of return, or you divide line 8 into line 9 to get the after-tax rates of return. The returns here look great at 85% and 63.8% respectively. Now, the above rates of return are only the current rates of return. The total rate of return is actually going to be different. Next year, revenues may be higher or lower. Your costs could be higher or lower. You will have to pay back borrowings, which will mean that your mix of OPM and equity will change. So just like the business, your return on equity is a living concept and it is subject to change. But you can estimate a multi-year running return by working out what you expect the average growth in cash flow and the average long-term equity to OPM mix to be. Then you can use what is called a constant growth formula, which is one of the most basic ideas in finance, by adding your cash flow growth rate to your current returns to arrive at a gross total rate of return. So if I think I can grow my cash flow by an average of 5% annually, all other variables equal, then the growth rate of return becomes 90%. Not bad. So how do people get rich? In the above example is your business throws off $159,000 a year. This equity cash flow should be after all expenses, which would include your market level compensation. After all, no one should run a company for free. The amount of this that you can take home may be reduced by any loan repayments, which will impact the equity to OPM mix. One way to get rich is by investing company cash flow or savings from compensation into added business expansion, which will alter lines 1, 2, 3, and maybe 4, 5, and 6. This is going to raise your wealth. Or you can save some of the $159,000 in personal savings or retirement accounts. This will also raise your wealth. The vast majority of businesses in America are generally vehicles to make a living and set aside savings. And often there is little left over after paying yourself a market wage. In the end, most businesses are sold or liquidated for not much more and often less than the equity shown in line 9. Still, having saved money can make business owners rich over time. But how do you get really rich? True business wealth creation comes from having a business that can produce an equity return in line 10 that exceeds what other investors would require from investments having similar current rates of return, similar risks, and similar growth prospects. An 85% annual pre-tax rate of return is a stout number. If another shareholder would only require a 20% rate of return, then the value of your equity investment has multiplied by more than 4 times. This is the secret of how business owners create wealth and become really rich. Until next lesson, I'm Chris Volk. Thanks for joining me on this value creation journey.